On April 23, 2023, Bed Bath & Beyond filed for Chapter 11 bankruptcy in a federal courtroom in New Jersey, 62 years after two men opened a single home goods store barely a mile away. Its stock, which had traded above $70 a share less than a decade earlier, closed that week at 23 cents. The story everyone already knows is that Amazon killed another retail chain. It's the same explanation applied to Circuit City, to Toys R Us, to Sears, convenient and mostly wrong, and repeated so often across the retail industry that it stopped functioning as an explanation at all and started functioning as a way to avoid asking what actually happened. Bed Bath & Beyond didn't die because people started shopping online. It died because for nearly 2 decades, the company took $11.6 to $11.8 billion in cash, some years more cash than the entire company was worth, and handed it back to shareholders through stock buybacks instead of investing it in the stores, the supply chain, or the e-commerce operation that might have let it compete with Amazon in the first place. And when the company finally tried to reinvent itself under a new CEO, the decision to rip out the national brands and the 20% off coupons that had defined the store for decades broke the one thing keeping the business alive: its suppliers' willingness to keep shipping product on credit. That decision landed at the exact moment the company's cash cushion, spent down over 20 years of buybacks, was no longer there to absorb the mistake. 4 internal decisions, 2 decades, and a company that, by the numbers, spent more money making its own stock look healthy than it ever spent making the underlying business one. This is the autopsy of exactly how that happened, one documented decision at a time. Bed Bath & Beyond started in 1971 when Warren Eisenberg and Leonard Feinstein opened a single home goods store in Springfield, New Jersey, under the name Bed & Bath. The concept was simple and, for its era, genuinely novel: a store entirely dedicated to bedding and bath products, at a scale and selection no department store bothered to match. The company added Beyond to its name in 1987 as the product range expanded into kitchen goods, small appliances, and home decor. Went public in June 1992 with a stock that opened near $1 a share and crossed $1 billion in annual sales by 1998. By the time Stephen Tamaris took over as CEO in 2003, Bed Bath & Beyond was one of the dominant specialty home retailers in the United States, competing directly against department stores and, increasingly, a growing number of big-box competitors. For most of the 2000s and into the early 2010s, that model kept working. The company's stock climbed steadily, eventually reaching an all-time high above $70 a share in January 2014. From the outside, everything about the company looked healthy: a recognizable brand, a loyal customer base trained to shop with a coupon in hand, and a stock price that kept climbing year after year. What that rising stock price was quietly obscuring is where this video's actual investigation begins. Amazon, meanwhile, was already deep into building out the logistics network and product selection that would let it undercut specialty retailers on price and convenience alike, and big-box competitors like Target and Walmart were investing heavily in exactly the kind of omni-channel infrastructure: buy online, pickup in store, same-day delivery, integrated apps that Bed Bath & Beyond would spend years playing catch-up on, using cash that, this video will show, was largely going somewhere else entirely. To understand what went wrong over the next 20 years, it helps to understand exactly what a stock buyback is and why it's a fundamentally different decision than it sounds like from the outside. When a public company buys back its own shares, it uses cash that could otherwise fund new stores, better technology, more inventory, or a stronger balance sheet, to purchase stock on the open market and retire it. Fewer shares outstanding means each remaining share represents a slightly larger piece of the company, which mechanically tends to lift the stock price and boost earnings per share, a number Wall Street watches closely. Used in moderation by a genuinely healthy company with more cash than it has good uses for, A buyback is a perfectly ordinary way to return value to shareholders. Apple and Microsoft, among many other highly profitable companies, have run large buyback programs for years without any comparable risk because their core businesses were simultaneously growing and generating far more cash than the buybacks ever consumed. Used aggressively year after year by a company whose underlying retail business is already losing ground to competitors, it becomes something closer to eating your own seed corn, spending down the exact cash reserves and operational investment a struggling retailer needs most, precisely because the buyback makes the stock look healthier in the short term than the business actually is. There's a reason this particular form of financial engineering is so easy for a board to justify to itself, quarter after quarter. A buyback doesn't require admitting the store experience needs work, or that the supply chain is falling behind competitors, or that e-commerce investment has lagged. It just requires believing the stock is undervalued, a belief that costs nothing to hold and flatters the people holding it, since a rising stock price also tends to lift the value of executive stock compensation. That's not a claim about anyone's specific motives at Bed Bath & Beyond. It's simply the structural reason buybacks are one of the easiest bad habits for a struggling public company to fall into, and one of the hardest to stop once shareholders and executives alike have gotten used to the annual number. Cutting or pausing a buyback program sends a visible signal to the market that management thinks the company needs the cash more than its shareholders do. An admission that's uncomfortable to make out loud, even when it's true, which is part of why boards facing a slowly weakening business so often choose to keep the program running rather than confront that signal directly. Bed Bath & Beyond chose the aggressive path, starting in the mid-2000s and accelerating through the following decade. The company began returning enormous sums to shareholders through buybacks, a pattern that continued almost without interruption through 2023, spanning 3 different CEOs, a near-death experience during the 2020 pandemic that briefly sent the stock below $4 a share, a bizarre run as a meme stock in 2021 that saw it spike to nearly $54 intraday, and, eventually, bankruptcy court. Through every one of those very different chapters, a pandemic, a speculative mania, 3 changes in leadership, the one constant was the buyback program continuing to run in the background, quarter after quarter, largely independent of whatever else was happening to the business. The scale of that pattern, and exactly when the company chose to accelerate it, is where this video's first internal decision begins. Between roughly 2004 and 2023, Bed Bath & Beyond spent between $11.6 and $11.8 billion buying back its own stock. The exact figure varies slightly depending on the source, CNN Business citing the higher number and Wolf Street the lower, but either way it's a sum that, in some years, exceeded the entire market value of the company itself. Roughly $9.6 billion of that total was spent just since 2010, meaning the majority of the buyback program ran through the exact period when Bed Bath & Beyond's competitive position was visibly weakening against Amazon, Target, and Walmart. The timing inside that total is what makes it more than an aggressive capital allocation strategy. In 2014, with the stock near its all-time high of $70 a share, but same-store sales already softening, the company spent $2 billion on buybacks in a single year. Money that went toward shrinking the share count rather than toward the store remodels, supply chain technology, or e-commerce infrastructure that competitors were already investing in. By 2017, the company's revenue had peaked. Every year after that marked a step down from a high point the business would never see again, and in 2021, a full year before Bed Bath & Beyond would start missing interest payments on its own corporate bonds, the company still spent roughly $1 billion buying back stock. Put those 3 data points side by side, and a pattern emerges that's hard to explain as anything other than institutional habit. $2 billion spent in a year when sales were already softening, a revenue peak the company would never revisit, and a full $1 billion spent the year before bond default. A healthy company buying back stock during genuine strength is one thing. A company continuing to buy back stock through 3 separate, increasingly visible warning signs is a different decision entirely. And it's the decision Bed Bath & Beyond's board and executives kept making year after year, right through the period this video's remaining 3 causes are about to cover. The 2021 buyback total is especially worth pausing on because of what else was happening to the stock that same year. Bed Bath & Beyond had briefly become a favorite of retail day traders during the meme stock frenzy that also swept up GameStop and AMC, with the stock spiking to nearly $54 intraday in January 2021 on pure speculative momentum, rather than any change in the underlying business. A board with genuine conviction that its stock was undervalued at that moment had an unusually good opportunity to raise fresh capital by selling new shares into that speculative demand. Instead, the company kept retiring shares through buybacks, even as a wave of retail enthusiasm was, briefly, willing to pay far more for the stock than the fundamentals justified. A missed opportunity that, in hindsight, stands in stark contrast to how the company chose to use its own stock as a financial tool. CNN Business, reviewing the bankruptcy in 2023, put a number on the pattern that became the company's unofficial epitaph, what the network's analysis called the $11.8 billion mistake that led to Bed Bath & Beyond's demise. The mistake wasn't spending money to please shareholders in isolation. Plenty of healthy companies do that responsibly. The mistake was doing it on this scale, for this long, while the underlying retail operation was visibly deteriorating and treating the buyback program as untouchable even as the cash available to fund the actual business kept shrinking underneath it. Wolf Street's own analysis, using the slightly lower $11.6 billion figure, framed the same conclusion even more bluntly, describing the entire program as money essentially wasted on a company that would go bankrupt anyway, rather than capital that ever seriously improved shareholders' long-term position. By the time Bed Bath & Beyond finally tried to fix its stores, the balance sheet that might have funded a real turnaround had already been spent, year after year, on making the stock price look better than the business underneath it. That's the decision this video's second internal cause builds directly on top of. On October 9, 2019, Bed Bath & Beyond announced Mark Tritton, an executive from Target, as its new CEO. The stock jumped 21% the day of the announcement, a strong vote of confidence from investors who wanted to believe a Target veteran could modernize a struggling home goods chain, the way Target itself had successfully modernized its own private label strategy years earlier. By 2019, the pressure on Tritton to move quickly was real. Quarterly revenue growth had turned consistently negative that same year, and the company's board was under increasing pressure from investors to show a credible plan for reversing years of stagnation. Tritton's plan was, on paper, coherent. Shift Bed Bath & Beyond away from the national brands that filled its shelves, the same well-known third-party products available at any competitor, toward private label merchandise the company would develop, brand, and sell exclusively itself at higher margins. Alongside that shift, the company scaled back the 20% off coupons that had been a signature part of the Bed Bath & Beyond shopping experience for decades. Coupons so ubiquitous that customers had learned to simply wait for one to arrive in the mail before making a purchase. The pivot touched core categories: bedding, bath towels, kitchen goods, where Bed Bath & Beyond's customers had spent decades building brand loyalty to specific, recognizable manufacturers, not to the store itself. The strategy might have worked at a company with a stronger cash position and a supply chain built to support it. Bed Bath & Beyond had neither by this point. According to Holly Etlin, the interim CFO, who later spoke publicly during the bankruptcy proceedings, the private label push proved too much for Bed Bath & Beyond's supply chain to handle. Private label products typically require longer development and production lead times than simply reordering an established national brand off a shelf. There's no existing manufacturer relationship to lean on, no established product to reorder in a pinch when demand shifts. That meant that just as Bed Bath & Beyond was trying to replace familiar brands with something new, it was also creating exactly the kind of inventory gaps a struggling retailer can least afford. Empty shelves in the categories it most needed to sell. At the exact moment, it was trying to convince customers to trust an unfamiliar new product line instead of the coupon-driven national brands they already knew. Removing the coupon program compounded the problem from the demand side rather than the supply side. Decades of habit had trained Bed Bath & Beyond's customer base to associate the store with a discount, and a meaningful share of that customer base had built their shopping behavior specifically around waiting for one. Pulling that lever in the familiar brand shelf at the same time meant the company was simultaneously testing a new product strategy and removing the promotional mechanism that had trained customers to walk through the door in the first place. It's worth being fair to the underlying logic here, because it wasn't an obviously foolish plan on paper. Private label merchandise typically carries higher margins than reselling national brands, and reducing dependence on deep, recurring discounts is a completely standard retail strategy for improving profitability. Target itself, where Tritton had spent most of his career, had executed a similar private label strategy successfully in the years before he arrived at Bed Bath & Beyond, building well-regarded in-house brands across home goods and apparel that customers came to seek out specifically. The difference is that Target made that transition from a position of financial strength, with a supply chain and balance sheet built to absorb the inevitable bumps of introducing new product lines, and did so gradually, category by category, rather than all at once. Bed Bath & Beyond attempted a faster version of the same playbook from a position that 2 decades of buybacks had already substantially weakened. None of this on its own was fatal. Retailers reposition their brand mix and adjust promotional strategy constantly, and plenty survive rougher transitions than this one. What made this particular pivot dangerous was its timing against the first internal decision. A company that had already spent down 2 decades of cash cushion on buybacks was now also asking its supply chain and its customer base to absorb a major strategic shift with far less financial room to correct course if either bet went wrong. If the first 2 causes in this video sound like separate stories, one about capital allocation, one about brand strategy, this block is where they stop being separate. The buyback program and the private label pivot didn't just each create their own problems independently. They collided directly inside the one relationship that determines whether a retailer can keep its shelves stocked at all: its standing with the vendors who supply it. By September 2021, Bed Bath & Beyond was sitting on roughly $1.1 billion in cash and about $2 billion in total liquidity. Not a fortress balance sheet, but not an immediately alarming one either for a retailer of its size. 2 months later, in November 2021, the company announced an accelerated share buyback program, spending $400 million in cash over the following 2 quarters. By the end of 2021, in total, the company had spent roughly $1 billion on buybacks that year alone. The same year, its underlying cash position was visibly shrinking, and a year before, it would begin missing interest payments on its own corporate bonds entirely. This is the block where the first 2 internal causes in this video actually collide. According to Holly Etlin's later testimony, the accelerated buyback caused some concerns amongst its merchandise suppliers, with vendors fearing the company would not have enough cash on hand to pay them in full. That's not a vague reputational concern. Suppliers to a retailer like Bed Bath & Beyond typically ship merchandise on credit terms, trusting they'll be paid in 30, 60, or 90 days after delivery, a system called trade credit that underpins almost the entire retail supply chain, and one that depends entirely on suppliers believing a retailer will still be solvent when the invoice comes due. When a retailer's own cash position looks shaky, and that same retailer is simultaneously spending hundreds of millions of dollars buying back its own stock instead of building up cash reserves, suppliers have a rational reason to worry they're about to be left holding an unpaid invoice. Vendors responded exactly the way you'd expect. They slowed shipments, tightened credit terms, and in some cases demanded payment upfront before goods would ship at all. That, combined with the inventory gaps already created by the private label transition from Block 4, produced a self-reinforcing cycle that's brutally simple to trace. Less trust from suppliers led to less inventory on the shelves. Less inventory led to fewer sales. Fewer sales led to less cash, and less cash gave suppliers even less reason to trust the company with the next shipment. By the time Mark Tritton was fired as CEO in June 2022, the company's cash position had fallen to just $107 million against a quarterly loss of $224 million. A company burning through cash roughly twice as fast as it had left in the bank. Reporting from Wolf Street around this period documented suppliers openly discussing pulling back shipments, a level of public vendor anxiety that rarely surfaces for a retailer that still has a credible path back to financial health. It's worth being precise about why this particular feedback loop is so hard for a retailer to break once it starts. A manufacturing company with its own factories can, in a pinch, keep producing even with tight supplier terms because it controls more of its own inputs. A specialty retailer like Bed Bath & Beyond doesn't manufacture anything. Its entire business model depends on other companies trusting it enough to ship product before getting paid. Once that trust starts to erode, there's no internal lever to pull that replaces it. The company can't manufacture its own way out of empty shelves. It can only wait for cash to recover enough that suppliers feel safe extending credit again. And cash was exactly the thing 2 decades of buybacks had left in short supply. The speed of the deterioration is itself part of the story. Bed Bath & Beyond went from roughly $2 billion in total liquidity in September 2021 to $107 million in cash by June 2022, a collapse of well over 90% in under a year. That's not the pace of a slow, manageable decline that a normal turnaround plan has time to address. It's the pace of a company that has already spent down its reserves for years, hitting a shock, the supplier pullback and the private label inventory gap arriving at the same time that a company with genuine financial cushion would have absorbed without most customers ever noticing. None of the 3 causes in this video so far required a single dramatic villain or a single bad decision made in isolation. A 2-decade capital allocation habit collided with a brand strategy that outran the company's supply chain, and together they broke the one relationship, supplier trust, that a low-margin retailer depends on more than almost any other. What happened next wasn't a quiet operational decline. It was a very public unraveling of the company's leadership, playing out in real time, in full view of Wall Street. In March 2022, the activist investor Ryan Cohen, through his firm RC Ventures, disclosed a 9.8% stake in Bed Bath & Beyond and presented the board with what he called a restoration roadmap, winning seats on the board in the process. The stock, already volatile from its earlier run as a meme stock, jumped as high as $27.23 on the news, investors betting that an activist with a credible turnaround plan might be exactly what the company needed. In mid-August 2022, a short squeeze briefly sent the stock up roughly 70% in a single trading session, the kind of speculative spike that had little to do with the company's underlying operations and everything to do with retail traders piling into a stock that had already become a meme stock favorite. That single-day spike is worth noting precisely because of what happened immediately afterward. It created exactly the kind of temporary price strength an insider looking to exit a large position would want to sell into. 5 months after Cohen's initial stake was disclosed, in mid-August 2022, he sold his entire position at prices between $18.68 and $29.22 a share, a substantial profit on a stake he'd built around $15.34. The stock fell roughly 40% across the sale, On August 23, 2022, a shareholder class action was filed, alleging securities fraud, naming both Cohen and the company's CFO, Gustavo Arnal, and alleging a coordinated pump and dump scheme, pointing out that Arnal had sold roughly 55,000 of his own shares for about $1.4 million shortly before Cohen's sale. It's worth noting, in the interest of factual accuracy, how that lawsuit against Cohen ultimately concluded. In June 2024, a court ruled in his favor, and the fraud allegations against him did not result in a finding of liability. 9 days after that lawsuit was filed, on September 1, 2022, Gustavo Arnal died. He had served as the company's chief financial officer throughout the buyback program's final years and the supplier crisis, described in the previous block. His death is part of the documented record of this period, and it's mentioned here only for that reason, as a factual marker in the company's leadership timeline during its most acute crisis, not as speculation about causes this video has no basis to make. The company confirmed his death publicly on September 4, 2022. Holly Etlin, who would later speak publicly during the bankruptcy proceedings about the buyback program and the supplier crisis, subsequently served as interim CFO through the company's final, most difficult stretch. The leadership churn around that period was severe on its own terms. Bed Bath & Beyond went through 3 CEOs in roughly 3 years. Stephen Tamaris, who oversaw most of the buyback program until 2019. Mark Tritton, fired in June 2022 amid the cash crisis his own brand strategy had helped deepen, and Sue Gove, who took over in October 2022 and inherited a company that was by that point functionally out of options. Each transition brought its own disruption. A new CEO typically means a pause while incoming leadership reassesses strategy, renegotiates with lenders and suppliers, and rebuilds trust with a board that's already lost confidence once. Bed Bath & Beyond went through that disruption 3 times in 3 years, at exactly the moment continuity and a clear, sustained strategy mattered most. Gove's team attempted 2 separate stock offerings in early 2023 to raise emergency capital. One in February, targeting over $1 billion that raised just $360 million, and a second in March targeting $300 million that raised only $48.5 million, with roughly 100 million shares sold into the market by mid-April in an increasingly urgent search for cash. Neither offering came close to closing the gap the previous 3 causes in this video had already carved into the company's finances. Each piece of this 4th cause is, on its own, a fairly ordinary event in corporate America. Activist investors take stakes and exit for profit constantly. Companies change CEOs. Stock offerings sometimes fall short of their targets. What made this particular sequence so damaging wasn't any single event. It was that all of it happened in the space of about a year at a company that, because of the first 3 causes in this video, had almost no operational or financial stability left to absorb the disruption. An activist investor entering and exiting a genuinely healthy company rarely triggers a crisis of this scale because a healthy company has the cash and operational stability to weather a few months of stock volatility and leadership uncertainty. Bed Bath & Beyond, by March 2022, no longer had that cushion, which meant every governance shock this block covers landed on a company that was already, in every practical sense, running on fumes. If a documented decision-by-decision account of exactly how a 52-year-old retailer ran out of options is the kind of story you want delivered every week, subscribing is the easiest way to catch the next one. We publish a new business autopsy on a regular schedule, back to the final months. By early 2023, every one of the previous 4 causes in this video had converged on the same balance sheet at the same time. 20 years of buybacks had spent down the cash cushion. The private label pivot had broken supplier trust. The resulting inventory shortages had driven sales into freefall. And 3 CEOs in 3 years had left the company without stable leadership at exactly the moment it needed to execute a difficult recovery. In February 2023, following the failed stock offerings, Bed Bath & Beyond's lender, J.P. Morgan, moved to protect itself. The bank slashed the company's revolving credit commitments from $565 million to $300 million and cut the available revolving line itself from $225 million to $175 million. That same month, the company missed an interest payment on roughly $1 billion in outstanding bonds, a formal default. Those bonds, which had traded as high as 16 cents on the dollar earlier in the crisis, a grim number in itself, fell as low as 5 cents on the dollar as the market concluded there was almost nothing left to recover. On February 7, 2023, the stock itself fell 45% in a single day after the company announced the terms of its emergency stock offering, a signal to the market in real time of exactly how little confidence remained in the company's ability to raise the capital it needed. On April 23, 2023, Bed Bath & Beyond filed for Chapter 11 bankruptcy protection in federal court in New Jersey. The company secured $240 million in debtor-in-possession financing from 6th Street to fund an orderly wind-down, keeping 360 Bed Bath & Beyond stores and 120 buybuy BABY stores open during liquidation, while a separate firm, Hilco Global, agreed to purchase up to $120 million in merchandise to help keep shelves stocked through the closing sales. The company's stock, which had traded above $70 a share in January 2014, closed at 23 cents in the days before the filing. The final numbers make the scale of the collapse concrete. Revenue for 2023 came in at roughly $5.6 billion, a decline of 55% from the 2017 peak, with the final quarter alone down 32% year-over-year. A company that had, at various points over the preceding 2 decades, been worth more than the $11.6 to $11.8 billion total it spent buying back its own stock, filed for bankruptcy, owning essentially nothing of comparable value in return. Put another way, the single largest use of the company's cash over 2 decades was larger than the entire company's peak revenue in a good year, a scale of capital return that, in retrospect, was never proportionate to the size of the business generating it. None of the 4 causes in this video was by itself an unusual or fatal business mistake. Companies run buyback programs for years without going bankrupt. Retailers pivot their brand strategy regularly. Suppliers tighten terms on struggling customers routinely without that customer collapsing. Activist investors, CEO turnover, and failed capital raises happen across corporate America constantly, survivably. What turned Bed Bath & Beyond's version of each of these 4 ordinary business events into a fatal combination was the order and the timing. 2 decades of buybacks had already removed the company's margin for error before the brand pivot, the supplier crisis, or the governance chaos ever arrived, one on top of the other in barely 3 years. Compare the arithmetic directly. $11.6 to $11.8 billion spent buying back stock against roughly $240 million in bankruptcy financing needed just to keep the lights on long enough to liquidate in an orderly way. A company that had, for 2 decades, treated shareholder-facing capital return as its default use of cash, spent its final months searching unsuccessfully for a small fraction of that amount just to survive 1 more quarter. Even the liquidation itself required outside help. Hilco Global's agreement to supply up to $120 million in merchandise wasn't a sign of confidence in Bed Bath & Beyond's future. It was a mechanism to keep the stores looking stocked enough to maximize what could still be recovered during the closing sales, for the benefit of creditors rather than the company itself. A company that had spent 2 decades treating its own stock as the priority ended its life, unable to fund its own final closing sale without a third party's help. Go back to the number this video opened with. Between $11.6 and $11.8 billion spent over roughly 20 years, buying back a stock that would eventually be worth 23 cents a share. That's not simply a bad investment. In hindsight, plenty of companies buy back stock at prices that later look expensive. It's a specific, documented pattern of choosing shareholders' short-term stock price over the operational investment a competitive retailer actually needed, sustained for so long and so consistently that by the time the company's leadership finally tried to change course, there was no financial cushion left to fund the change or to absorb the mistakes that came with attempting it. Warren Eisenberg and Leonard Feinstein built a genuinely good retail concept in 1971. A single category, executed with more depth and selection than any department store bothered to offer. That concept survived and grew for nearly 50 years. What killed it wasn't a rival with a better website. It was 2 decades of a board and a CEO choosing to return the company's cash to shareholders instead of reinvesting it in the exact operational strengths, supply chain, e-commerce, store experience, that a home goods retailer would eventually need to survive Amazon at all. By the time Mark Tritton tried to fix the brand, and by the time suppliers responded to a shaky balance sheet by pulling back credit, and by the time an activist investor's exit and a leadership crisis compounded the damage, the company was trying to solve 4 separate problems with a checking account that had been drained, one buyback at a time, over most of the preceding 2 decades. That's the mechanism underneath the headline. Amazon changed the competitive landscape every physical retailer had to operate in. That part of the popular story is true, but plenty of specialty retailers found ways to compete with online shopping without collapsing into bankruptcy. What Bed Bath & Beyond did differently wasn't losing to a better competitor. It was systematically removing its own ability to respond to that competitor, one multi-billion-dollar buyback at a time, for the better part of 20 years, until there was nothing left in reserve when the moment finally came to actually fight back. Home Depot, Lowe's, and even Target all faced the exact same Amazon-driven pressure on physical retail during the same 2 decades, and all 3 found ways to keep investing in their own competitiveness while Bed Bath & Beyond kept prioritizing its stock price instead. There's a broader lesson here that applies well beyond one home goods retailer, and it's worth stating plainly, rather than leaving implicit. A rising stock price is not the same thing as a healthy business, and a board that consistently prioritizes the first over the second is making a bet that the gap between the two will never come due on its watch. For roughly 15 years at Bed Bath & Beyond, that bet paid off. The stock kept climbing, the buybacks kept the earnings per share numbers looking strong, and the underlying erosion in competitive position stayed mostly invisible to anyone looking only at the share price. The bet only stopped paying off when the company needed real operational strength to survive a difficult transition, and discovered that 2 decades of buybacks had spent the exact reserves that strength would have required. By then, the gap between the stock price and the business underneath it had become too large for any single new CEO or any single stock offering to close. None of the 4 executives who ran Bed Bath & Beyond across these 2 decades set out to bankrupt the company. Stephen Tamaris ran a buyback program that looked for most of his tenure like a defensible use of a profitable retailer's cash. Mark Tritton pursued a brand strategy that had worked at his previous employer. Sue Gove inherited a crisis and tried unsuccessfully to raise the capital needed to survive it. Each decision, examined in isolation, and at the moment it was made, had a case behind it. The autopsy isn't about assigning blame to any one of them individually. It's about what happens when 4 individually defensible decisions made by 4 different people across 2 decades all draw down the same finite resource, cash, without anyone along the way stepping back to ask whether the company could actually afford all 4 at once. That question, asked at almost any point along the 20-year timeline this video has covered, might have changed the ending. It doesn't appear in any of the documented record to have been asked seriously until there was no longer enough cash left for the answer to matter. 52 years, 4 internal decisions, and a company that ultimately proved more efficient at returning cash to shareholders than at staying in business long enough to keep making any. The lesson isn't specific to home goods retail or to any one of the 4 executives whose decisions this video traced. It's about what happens whenever the metric a company optimizes for stops matching the thing that actually keeps a business alive. If you want the next documented decision-by-decision breakdown of how a household name actually collapses, subscribe to Market Autopsy. We publish a new investigation like this every week.